This is accounting on Excel with Amaka Ifeibonando, the Excel coach. And in this training, I'll be showing you how to record your financials in this template. And this is for a service-based business. So if you render service, your business is basically for rendering of service, then you would like to stay tuned with me in this training. Let me show you how you can record your financial and also generate your income statement and your balance sheet automatically. Right. So this is the case study we'll be working with. We'll have a case study. And before we go into the case study, let's walk through the other section to see what this template is made of. First of all, your chart of account. Here we have the chart of account code. For all the ones is assets, all the two is liability, all the threes are equity, the four income, and 5 to 7 is expenses. Now, based on this code here, you now generate your chart of account. As you can see for Joy Delivery Enterprise, we have generated the chart of account. Now, you have to look at your business. What are the transactions that are key to your business, or what transaction do your business involve in? Those things will help you generate the account that will be involved in carrying out transaction in your business. So these are the things. After looking at the transactions here and what the business will be doing, it helps us to generate a custom chart of account for Joy Delivery Enterprise. Now, for the general ledger, this is where we'll be making the entry. If you're not an accountant, you should have it in mind that in accounting, for every debit entry, there's a credit entry, meaning that the total debit will always be equal to the total credit. And that's why you have this accuracy check here. So when it's not equaling the same amount, then it will give you an error check saying not balanced, right? So this is just to guide you to know if you have made accurate entry for each transaction, right? So you have the dates, you have the description, you have the account number and the account type. While we are imputing, we'll talk more on this section. So the final section is your report, where we have the financial statement. Now you won't have any need to make any inputs here. Rather, the little input you need to make is on this date. Now, what reports do you want to generate? Which date report? If you want to generate report for January, mind you, for financial statement, we are saying for the month ending. So you put the last day of the month. Like now, for January report, you put the last day of January, right? So this particular cell here that you're seeing balance is an accuracy check. It checks to be sure that your balance sheet is balanced. As you can see, the balance sheet is balanced. So your total assets, it has to be equal to total liability and owner's equity. So this is also a check for you. So if you see it's not balanced, that means something is wrong and you have to go back to your general ledger to make the necessary entry. Right. So this start date, when did you start using this template? And when did you start imputing transaction? Right. So for Joy Delivery Enterprise, started using this template 1st of January 2024. So you put in your date. So just this, and this is where you make your entry. The rest is automated. And here you can put your business name. The business name is Joy Delivery Enterprise, and everything here will automate. So you have the report date, which is the last day of the month you want to generate. When you started using the template for Joy Delivery Enterprise, started on the 1st of January 2024, and this is the name of the business, Joy Delivery Enterprise. Right. So right now, let's go into the case study and look at it one after the other. It says Amaka started a delivery service business called Joy Delivery Enterprise in January 2024. Below are the transaction details for January 2024. So on the 1st, Amaka started by putting her personal money of 5 million into the business. Deposit was made into the business bank account. So we go to our general ledger. So you put the date, 1st of January, what do you call it? Startup capital. And we now selected. So there's a drop down list here. And this drop down list was generated using the chart of accounts we created here. Right. So we have our drop down list. So immediately you click on the drop down list, you can pick the account that is going to be affected. So first of all, we paid money into the Ultimate Bank. The Ultimate Bank is the official bank for Joy Delivery Enterprise. So you select it because the bank amount will increase, and assets, when you debit it, it increases. So the account type here will just pop up immediately. And this is a formula cell. You don't need to tamper with it. So whatever you select here, it will give you the relevant account type. And all this, you can see it as is generated from this chart of accounts section, right? So you put in the amount 5 million. Then the second entry, for every transaction, there is at least 2 entries. for you to have a balanced general ledger, right? So for the second entry, it will be the same date, it will be the same description. Now, the account, what's the second account you are putting it? The owner's capital. The owner's capital, because Amaka is giving the business 5 million. The business is owing Amaka, so we have to send it into the owner's capital. So immediately you select the owner's capital, which is an equity account, it will just pop up equity, right? Then it will be a credit entry. So for credits, for owner's capital, the default balance is credit. So when you put 5 million there, it increases the owner's capital, right? For those that are not accounting, just follow me. It's quite easy. The more you keep doing it, the more you understand, right? So let's go back to the case study. The second transaction, which is still on the 1st of January, says Joy Delivery Enterprise pays 600,000 as annual rent for office space. 600,000, this is office space. So you put your dates, because it's the same date, I'll just say copy Control D, then I'll say annual rent. Annual rent. So annual rent, which account is going to be affected? Now, money is leaving on our account, right? But we are paying it for annual rent. And that annual rent is going to last for, is going to cover for 12 months, a period of 12 months from January to December, right? So now, what you have to do, you don't need to expense it, because that annual rent of 600,000 is not only going to be spent in January. So first of all, you capture it in an account where we call prepaid rent. At the end of the month, we're going to do some adjusting entries. Then we will now capture the one that is specifically for January after we've done some calculation. For now, just send it to a prepaid rent. So you've paid for 12 months, right? So, but you made the payment in January. So we'll send it to a prepaid rent. Immediately, as I said, it will pop up the account type. How much did we pay? Mind you, the first entry is a debit entry, and that is why we started with the prepaid rent, which is a debit. It's an assets account, and we are increasing that account. For every assets account that you want to increase is a debit entry. So it's 600,000. All right. So you see, it just said not balanced, meaning that I have not made the second entry. So what's the second entry? It's still the same date as I state, and it will see the same description. Now, what is the second entry? I paid that money. Money left the bank, right? So you have to select the bank. So the bank reduced. There's a reduction in the bank amount, the money in the bank, because we have paid for our rent. So you select Ultimate Bank and you credit it. Mind you, for access, if you want to increase it, you debit. But now, because money is reducing in our bank account, we'll put credit. So you say, you put the equivalent amount. Mind you, immediately it balances. So that is the entry for this transaction for payment of annual rent. Now let's go to the third question. It says on the 5th of January, Joy Delivery Enterprise purchased a delivery van of 3 million. Payment was made via bank. On the 5th, Joy Delivery Enterprise purchased a delivery van of 3 million and payment was made via bank. So we'll go back to our general ledger. On the 5th of January, what did we buy? Delivery van. Delivery van. This is an asset, right? So we'll look for assets account. There should be a vehicle account we should have, which is an assets account. So we'll look for motor vehicle. This is it. So because it's an assets account, debit increases assets account. And we paid 3 million for it, right? 3 million. Good. So, okay, this is supposed to be 3 million. So add 10. So always check to ensure you capture it accurately. So we've made the first entry. Now let's go and make the second entry. If we didn't make the second entry, it's telling us not balanced. So we'll still use the 5th of January, still delivery van. Then we paid via bank, meaning that money left our bank will reduce. So we'll select Ultimate Bank. Money left our bank, and because our bank is reducing, there's going to be a credit entry in our bank to reduce the amount that left, right? So I think this is it. Good. So that's the entry for this transaction. Let's move to the next transaction. On the 6th, it says Joy Delivery Enterprise received a loan of 2 million from Amaka's mom to pay back for a period of 10 months at interest rate of 5%. So on this day, she received a loan, but she's going to be paying back that loan for a period of 12 months at an interest rate of 5%. So first of all, let's just record the loan that Joy Delivery Enterprise received from Amaka's mom. So this is a loan. So go to our general ledger, and this was made on the what 6th of January. So on the 6th of January, the 6th of January, loan uh, from Amaka's mom. We just put it loan from Amaka's mom. So she received loan from Amaka's mom. So because Joy Delivery Enterprise is receiving loan, right, there is something that is going to be increasing. Money is coming in, right? That money was paid into the business Joy Delivery bank's account. So first of all, the money she received from Amaka's mom, that's the business Joy Delivery Enterprise received from Amaka mom, will increase her bank because money is entering her bank. So you select the bank, Ultimate Bank. Ultimate Bank. Remember, it's an asset, and whatever that will increase an asset will be on the debit side. So how much is 2 million that was given to Joy Delivery Enterprise, right? So what's the corresponding entry we need to make? We need to make another entry, and that entry will be going into a liability account because this money has been received as loan. So we are liable to pay. Joy Delivery Enterprise is having a liability. So there's supposed to be a loan payable account. So let's look out for loan payable accounts. So you see loan payable, showing that this account, this is what the business Joy Delivery Enterprise is liable to pay Amaka's mom, right? So immediately it pops up that it's a liability account. And for a liability account, the default balance is credit. So whatever that will increase liability account, we should be on the credit side. So you put 2 million. Now I didn't put this is 200,000. You saying that's why it's saying not balance. So you put your 2 million, make sure it's 2 million. Right, good. So it's balanced. So before we proceed, let's look at our financial statement. As I stated, the financial statement automatically generates itself. Now let's look at it. So it's showing us that it's balanced, right? So let's go. All our transaction we'll be making has been in the balance sheet account. We've not made any input that will capture in the income statement. So our balance sheet, our report is really moving on fine. So asset is 7 million and total liability is also 7 million. That means we are moving in the right direction. So let's proceed. Now, the next transaction on the 7th, it says Joy Delivery Enterprise pays 600,000. Before I proceed, now there are adjustments we need to make. There are adjustments we need to make for this rent, the van, and the loan. That's why you have here end of month adjustment, because this amount we need to charge a specific amount to each month because this money was made for 12 months. So which amount goes to January? This delivery enterprise purchase van was for 3 million. And now it says the delivery van will last for 5 years, right? This is another information we need to know and to calculate the depreciation. This we will do. Then Joy Delivery Enterprise received a loan of 2 million from Amaka's mom, and she's going to be paying back in a 10 months. So we need to calculate the interest rate for each month because each month there's an interest rate that will accrue because the 5% interest rate will be shared across the 10 months, right? So this is something we need to do, but it will be at the end of the month before we do that. So let's proceed. On the 7th, Joy Delivery Enterprise pays 600,000 to cover for 12-month insurance premium on the delivery van. Now, having bought the delivery van, Joy Delivery business saw the need to insure the delivery van. So it's paid 600,000 to cover for 12 months insurance premium. So on the 7th, we have 12-month insurance premium. On the 7th of January 2024, insurance premium, insurance I believe I got this right. Good. So paid. So money left. When money leaves our bank account, it's reducing it. So it's a credit because it's an assets account. So the first one now is insurance premium because we are making a payment in advance for 10 months, but we are making that payment in January. So there's going to be a prepaid insurance account like it's an asset, it's a prepaid insurance account, right? So prepaid insurance because you've made payment for 10 months in January, right? So we'll put it in this prepaid insurance account. And when we're making the non-cash transaction entry, non-cash adjustment entry, we'll take a particular part of this amount and charge in January, you charge in February, and that's what you do at the end of each month, right? So how much did you pay? Think it's 600,000. So this increases. So the next account that will be affected is our bank account because money left our bank account. So we select our bank account, money left, and money leaving our bank account will reduce it. So it's a credit entry. Good, and we're good to go for that. So the next one is on the 10th of January, Apple Incorporation paid 20,000 for 5 parcels to be delivered to its customer. Joy Delivery Enterprise made the delivery same day. So he paid 20,000 for 5% to be delivered to his customer and Joy Delivery. So this is a service that is rendered and payment was made. So on the 10th of January 2024, so we say service delivery, let's call it service delivery, right? So you debit your bank because money came in, and let's assume the money was paid into the bank. How much? 20,000. Then the second entry for this transaction will be our revenue account. Money was made, service revenue, income. We made an income of 20,000. Income account is a credit balance by default. So whatever that will increase it will be a credit. So because we sold, we rendered service, income came in, so the income account increased. So if you look at your financial statement, notice you have your service, 20,000, right? So we are good to go. Now, the next is this. It says Samsung Incorporation needs 2 sets of parcels to be delivered as soon as possible. Joy Delivery sent an invoice amount of 30,000 to Samsung Incorporation and also made the delivery same day. So Joy sent an invoice and also made delivery same day, but payment is yet to be received. So they are yet to receive this 30,000, but they have delivered the service. So how do we make this transaction on the 12th? So on the 12th of January 2024, there was a service delivery, right? So first of all, because money was not received, the service was rendered, but payment is yet to be made. So we have a receivable account. We are expecting money. So we capture it in our account receivable because we have rendered the service. Joy Delivery Enterprise have rendered the service, but money has not been paid yet. So account receivable is an account that you put in transaction that service has been rendered, but payment has not been made. Right. So how much are we expecting? 30,000. So 30,000. So what's the next account we're supposed to capture? Because we rendered service is a service revenue account to put. So we've rendered the service, not minding we've not received the money. So it's an income. This is an accrual basis. So we're assuming this is an accrual basis. We have rendered the service. Money has not been paid, but we have rendered. So for Joy Delivery Enterprise, they are due for this money. So service has been rendered. So this is a money that is recognized as income, right? So put 30,000. I believe that explains it, right? Good. So let's just keep going. Now the next transaction says on the 14th, it says 50,000 cash withdrawal for office running. So there was a 50,000 cash withdrawal for office running, and that was done on the 14th. So on the 14th of January, 2024, cash withdrawal, just put it that way. So cash withdrawal, so meaning that money left the bank into the cash at hand. So first of all, we debit the cash at hand that will increase because whatever that will increase our assets is debit. So cash at hand will be increased. So we debit it with 50,000. And we'll now credit the bank that releases the money. So bank, ultimate bank, because that's where the money left. So there will be a reduction in bank. So it's an asset and it's reducing. So it's credit, 50,000. Good. So that is it for that transaction. So what's the next transaction? It says on the 15th. Okay, this was on the 14th, down this 15th. On the 15th, Vehicle fueling, 5,000 cash. So we paid for vehicle fueling. Okay, this is 15. Vehicle fueling, vehicle fueling, right? So vehicle fueling is an expense account. So look for an expense account. Okay, this is vehicle fueling. Good. So we paid 5,000 cash, right? We'll debit it because for every expense that we incur, it will increase the expense account. Expense account by default has a debit balance. So when we keep incurring expense, the expense account will keep increasing. So we keep debiting it. Now, money was taken from the cash at hand. So money was taken from the cash. So the next account that will be affected will be cash at hand because we paid cash. So you go to your cash, money will be reducing from your cash at hand, and that's why you credit it to reduce that money, right? So that's the entry for that transaction. So the next one says electricity bill for 3,000 was paid cash. Electricity bill. So let's say electricity bill. I think what date is that? 17th. Electricity bill, 17th of January 2024. So we just say electricity. All these are just for us to understand better. Electricity bill, right? So electricity bill is an expense. So look for an expense account called electricity expense. Good. So it's an expense account. So expense account, where to increase it, you debit it. So it has the same behavior with assets. Expense and assets has the same behavior, while liability and income has the same behavior. When you just know this, it will be easy for you, right? So because we are making an expense of electricity bill, our electricity bill will increase and we'll debit it. I think it's 3,000. If I'm not mistaken, we can check that. Yes, 3,000. We paid cash, so we paid from cash at hand. So cash at hand will definitely reduce. So you select cash at hand here. So because it's reducing, it's going to be credits, 3,000. Good. So what's the next transaction? It says Amaka withdraws 10,000 cash for personal use. Now, this is a withdrawal Amaka made on the 20th of January 2024. Amaka withdrawal. Amaka withdrawal. So she withdraws 10,000 cash. So this kind of transaction is what will affect drawing. So the owner of the business is withdrawing money for personal use. See, it says for personal use. So the owner of the business, which is Amaka, that owns Joy Delivery Enterprise, is withdrawing money for personal use. Right. And for such kind of transaction, the account that will be affected is a drawing account. And that drawing account is still under equity, though it's a contra entry. Now, let me not bug you with that. It's just a drawing account. So the whole thing has been automated. So we'll debit it with 10,000. And the next account, so money left, so Maka took cash from cash at hand. So your cash at hand will reduce. Okay, cash at hand. So we have cash at hand, and because it's reducing, it's going to go to the credit side, right? And this is the entry we've made thus far. And for all the transaction captured, right? For all the transaction is balanced. You can look at your financial statement. Wow. So it's telling us it's balanced because our financial statement is as at the last day of January and all the transaction we have imputed is for January. So you can see the total, your net income is 42,000. You made a sales of 30,000, expense of electricity expense, vehicle fueling, and total expense is 8,000. You have a profit of 42. Then your balance sheet, you can see everything. Your total assets is equals to your total liability. Everything is balanced. You can look at the drawing you made and look at your retained earning, which is your profit for the year, this will capture in your retained earning. So this automatically capture, and when you do your print preview, you will see it prints automatically, right? So I'll stop here in this particular training. In the next one, we'll be doing the adjusting entry, the non-cash adjustment, so that this video will not be too long. So we've captured all the transactions, right? So all that is required is just for us to do end of month adjusting entry. So in the part B of this tutorial, we'll be doing the end of month adjustment. As you know, we have a lot of end of month adjustment. As you can see here, I've highlighted them. So we'll be doing that, right? So I believe this has made the work much easy for you. If you're a service-based business, give this a try. You see your transaction is captured. As you're capturing it, your report is being generated automatically. And when you click on your print preview, you can see this is your income statement. Page 2 has your balance sheet. It prints automatically, right? So thank you for staying on in this lesson and in this training. I'll see you in the next training and the part 2 of this section. Thank you, and do well to like this video, share with as many that will benefit from this. Hit the subscribe button, hit the notification bell to get notified whenever I upload value tips. Thank you, and see you in the next training. Bye for now.